members. It is a very special day, 31st October, that extension of tax and due dates. We have planned very well, and accordingly we are doing the study circle. I appreciate the members' presence for the today's study circle. On behalf of our Bangalore branch, I welcome you all for this today's study circle. It's an Indian outbound companies tax consideration to company, tax consideration that company should look out for. We have with us very well resourced persons on the subject. She Priya Narayanan and she Chandrashekar Acharya. I request Chairman of the Bangalore branch, Shri Shavan Gurutur, to escort the speaker to welcome them with the floor bouquet. Also, request the Chairman to present a moment also. Priya is a director in Revised Bangalore office. She specializes in tax issues associated with cross-border transactions, besides handling compliance and regulatory matters. Her expertise lies in structuring Indian inbound and outbound investments, developing cash repatriation strategies, or conducting international tax optimization studies. Priya has valuable experience in serving clients in the technology, media, manufacturing, and pharmaceutical business. Has contributed articles that are published in tax conferences, tax magazines, newspapers. With this brief introduction, I present before you C.A. Priya Narayanan. Welcome you, madam. C.A. Chandrashekar Acharya is serving as a senior manager in Revised Bangalore office. He has more than 7 years of experience in direct tax and international taxation. He has handled litigation support, tax structuring, and compliance matters of clients in technology, manufacturing, pharmaceuticals. He has written articles on international taxation. With this brief introduction, I present before you C. Chandrashekar Acharya. Welcome, Chandrashekar. What will you?
Introduction and giving us an opportunity to present here. It's always humbling and honoring to come back to the institute and present on topics that you've learned. And you always exchange notes, you learn from each other and you present. So, good evening everybody. The topic that Chandru and I are here to discuss is in relation to outbound investments from India, largely relating to the tax consideration, and we'll touch upon a bit of FEMA as well. Now, one of the things that comes to our mind is why is this topic relevant today? For example, 20 years back or 30 years ago, when the IT industry was booming in India, all the large IT companies have already set up their outbound investments, outbound companies, either for servicing their clients or to do certain activities for the in-house operations or probably for marketing services. So the reason that we see that this topic could again become relevant in the near future is because of startups. So with a lot of startups that are coming in, and Bangalore being the largest startup capital in terms of the Indian context, this topic is going to gain significant amount of importance because many of these ideas that are being floated here in Bangalore are being taken to overseas markets also. So when that level of overseas investment comes in, as practitioners, we would obviously want to look out for items that we have to consider when we, advise our clients on startups and outbound investments of these startups. With this brief context in mind, I will introduce the topic and I will also lay out. So this is the content of the slide in terms of what we are going to talk about today. In any company's setup phase, that is when an Indian entity sets up an entity outside of India, there are different phases that it goes through. So the entire slide pack has been designed in a way that we can split it into subtopics and walk you through each phase and what are the potential issues or regulations that we need to be aware of. So for example, we have started off with pre-incorporation. That is, even before you incorporate your entity outside of India, what are the considerations that companies should think of and what are the evaluation parameters when it comes to choosing the jurisdiction. The second one being incorporation itself, the act of incorporating and setting up the unit. What is the form of business I should choose? Should I choose a company? Should I choose a LO, the license office, or should I choose a branch office? It could also happen that certain countries might allow you to explore that market without really setting up any entity form. So, you can directly explore for a limited period of time without having any entity form. The next aspect is when it becomes operational. You have thought through, incorporated the entity. The next level that comes in is the operational aspects. That is, you have the routine payments from head office going into the subsidiaries, or you have the UPOM regulations, the anti-avoidance rules. So when the operations start, what are the factors that we need to bear in mind when we advise our clients? The next item is regarding the employee-related activities. You might send some of your employees from here to the overseas entity. You might float ESOP for employees from here to the overseas entities. And then obviously when your entity is up and running and turns profitable, there will be cash repatriation, that will have to come in. If I remit the amount as part of capital, equity or debt, and therefore dividend or interest, what is the tax consideration that goes in when you compute the entire flow? And at a group level, what's the effective tax rate that I should be looking at? The last one relates to the exit strategies, which is that assuming that it is fully complete the project that you had started the overseas entity for. Either you sell it off, you wind it down, or you can even merge it with another entity. So what happens at that level? So this is the broad structure of the presentation that we are going to take today. It has quite a few smaller items that we will deal with. For example, the POEM guidelines is something that would be relevant. So we may deal with it in a limited portion here, and if required, we can do a blown-up session only on each of those parameters later. So let me start off with the pre-incorporation related aspects. Now, the first thing that comes to, in a business you always have an organization structure which has a finance vertical, which has a tax vertical, and then you have business verticals. So the business is always the key decision maker in terms of deciding where the growth should happen. So the business comes and tells the finance team, and within the finance team, the tax team, as to where they expect a new business to come in. And that new business could be in terms of a product to be sold in the market, or just setting up a marketing facility in that overseas jurisdiction. So the first aspect that I would like to highlight is, it's mainly for business reasons that companies go outside of India. The second reason, which probably is not so significant, is for setting up in-house centers. Now, setting up of in-house center is more prevalent in case of inbound investment. That is when companies are trying to set up operations in India to save on the cost that potentially arises if it was outside India, the same set of operations. So the cost arbitrage is one thing that people would set up in India for. But even when you set up outside India, some companies may have some small limited operations of in-house centers outside, either as a BCP plan or probably as a secondary source where there is a cost saving. Now the third aspect is the choice of jurisdiction. I'm going to deal with this in a little more detail because the choice of jurisdiction is twofold. The first one is that the ultimate entity where your, the ultimate jurisdiction where your entity is going to be located, which we have decided is a business-driven decision. And the second one being an intermediary jurisdiction that you might want to hold all your holdings for that region in. So there are twofold decisions on jurisdiction, and then you have the form of entity. So even for the intermediary jurisdiction and the final jurisdiction, you will have to decide what is the entity form that you want to set up in. Is it a branch office, license office, a company, a JV, or you want to start off with a limited operation without any setup and then go into a full-fledged operation. Now in all of this, what is critical is regulatory implications, which is the company law provisions in India, the FEMA related provisions, what would apply to outbound investments, and also in those respective jurisdictions that you choose. Today's conversation is going to be largely limited to the India related regulations because the overseas one would really depend on the entity that you choose and the jurisdiction that you choose, and obviously the income tax considerations. Now in income tax considerations, there is one point that I would like to highlight is while the ultimate entity could be in our jurisdiction, which is say C, and we are sitting in jurisdiction A, the choice of B could actually determine what's the global effective tax rate that you're paying as a group in A. So these are the, this is probably the layout of what are the items that a company should really consider when they are going outbound. This slide talks about the holding structure pattern. So typically, if you look at a plain vanilla or a simple holding structure, you have a parent company in India which holds a subsidiary outside India. This is called as a plain vanilla structure because it's a direct holding. The shares are directly invested in. However, there are options that you can set up an intermediary holding company in a third country and then move into the ultimate jurisdiction. One question may arise to many of us that, with the amendments that have been proposed in the tax treaty network, either under BEPS or independently, whether it's the Mauritius Treaty or the Singapore Treaty, what is the relevance of having an intermediary company, in a jurisdiction? Because anyway the treaty network does not provide you relief. Any thoughts on this? So, what really happens is the choice of intermediary holding company need not be a decision driven by tax. That is, it is not for obtaining a tax advantage that you set up an intermediary holding company. The holding company can be set up for other reasons. One of the reasons could be having or establishing a regional headquarter. I as a company in India want to expand into the European zone. Therefore, I decide, say country in UK, UK as a country, to have the intermediary holding and have all my subsidiaries for the European region under that. Similarly, for APAC region, I might want to choose Singapore as a holding company to, facilitate all my regional activities. And those countries which you normally choose as intermediary holding company would provide additional flexibility in terms of movement of capital and probably, it's more business friendly. So there are reasons other than tax that you still want to go for, having an intermediary jurisdiction. In evaluating jurisdictions, again when I talk of jurisdiction, it's largely relating to the intermediary holding jurisdiction because the ultimate is driven by business. So in deciding what is the choice of jurisdiction that I need to go through, there are about 12 considerations that companies normally factor. The first one is the restriction of activities. Now, restriction of activities could be in terms of what activity is permissible under the local law of that country and what activity is not permissible. From an Indian context, from 1991 up until now, we have had various levels of liberalization and opening up of the economy, which has led to opening up additional industry investments into India. Similarly, many of the foreign countries may have regulations which permit or do not permit overseas investment. Given this, the first factor that we need to consider is actually whether the overseas jurisdiction permits the activity that we are looking to invest for. The second one is flexibility in investment of capital and reserves. One of the main considerations as a businessman would be that today I go and invest in a country. Am I able to pull back the capital easily? or does it require regulatory approvals or tax approvals to pull back even the capital amount? And that is the decision driver in terms of having an intermediary jurisdiction which allows easy and flexible movement of capital without too many regulations in place. The third one relates to the joint taxation of group companies. Now, companies can establish more than one entity in a jurisdiction. Today in India, we do not have the concept of group taxation. For example, you have two companies of the same parent and both the subsidiaries are an Indian entity. We can't file a joint tax return for both of them together. But some of the countries may permit joint tax return on a consolidated basis for certain activities. Now that is another consideration that companies look for, or when they have an outbound investment, that for some business reason I need to have two companies in that jurisdiction. Can I just consolidate and file it? The next consideration is the substance requirement. Now when it comes to substance requirement, it is really a difficult concept to explain what is a substance in a simple term. But if you just step back and think, the requirement of substance is nothing but that the activities that I have documented, that the activities that I am doing are in substance the same. Which means to say that if I have a holding company in X jurisdiction and I have said that my entire regional operation is going to be managed from that country, then it is just not on paper that the management is happening from that country, but I have people sitting there, I have assets located there, and I have resources located there to prove that yes, the activities are being conducted out of that jurisdiction. So that is a simple example of what is substance over form, that I just don't have a regional entity over there, but I also have substance infused in that entity. The next one relates to special tax regimes for holdcos. Many countries provide special tax regimes and exemptions if you have holding companies in that jurisdiction, and they also provide tax credits for income that accrues there, or they may even exempt foreign sourced income. That's another consideration, so that the income that comes from the ultimate entity through the intermediary to the ultimate, when it flows through, the tax cost is lesser. The other one is in relation to participation exemption, and this a lot of European countries apply this. That is, if you have a certain minimum threshold of participation in a subsidiary, you may get exemption for disposal of shares or for dividend income. So this is largely a European concept, and you also see it in some of the tax treaties. The other consideration that you would see is the treaty network, and the reason that you would see whether the treaty network is strong is because that if there is a dispute with the tax authority in that country in future, it is only the treaty that probably comes into protection that you can avail the benefit of to see whether the litigation can be resolved in a more amicable manner. The other aspect is the effective corporate tax rate. Many of the countries have gone for a corporate tax rate in the region of say 17 to 22% today, whether it's the US, UK, Singapore, Hong Kong and all of that. So the effective tax rate is also a critical factor in determining what will be the overall tax cost in the intermediary jurisdiction. Just to briefly touch upon the others, I think the tax investment and disposal is obviously a very, very critical criteria that tomorrow, yes, sorry.
One Indian company in Bangalore, its startup company is growing, and the MD is having a major shareholding in that Indian company.
Okay.
He has started a company in US, San Francisco, with a nominal capital.
Okay.
They are looking for that marketing and all these things aspects will be growing there. Is it that as the companies act in India, does it cause any problems for tomorrow for any consolidation or any problems?
Yeah, so sir, I would like to really answer this. Let me get the facts right. You have an individual who owns an entity in India.
Yes.
You have an individual who owns an entity in US, and the entities are not linked, but it's rather through the individual ownership that is linked. So one thing that I would like to highlight is that if it is particularly a startup, tomorrow if you are looking at externalization, dilution of interest or sell-off of the entity, the value of the company is not consolidated in a group level. He will have to independently sell off the shares here, he'll have to independently sell off the shares there. But if it were to be consolidated as a group entity, probably, it's easier even from a buyer's perspective to acquire the shares. So more than tax, I would think it's to do with exit strategy, whether it's the right decision to take. So the next thing is on taxation of the intermediary companies, the legal protection of intangibles. Now the intermediary holding jurisdiction can also be chosen for legal protection of intangibles. That is, if you have a lot of IPs being developed or patents being developed, and there are countries that offer incentives one and legal protections two for holding an IP in that jurisdiction. And many of the companies, especially where the technological advancement is very high, would want legal protection for their patents and intangibles. So that's another consideration to choose, which country that you need to go for. We discussed this briefly, but yeah, from an Indian outbound perspective, when you have an intangible, say a technology that you want to house, many of them may want to house it in India because the promoters are Indians and the income should come into India and then go get distributed to the promoter's hand. Some of them may want it to be in a jurisdiction outside India for non-tax reasons, and it could be for business reasons, for legal reasons, because their customers are in the overseas jurisdiction, and for those reasons you do see. But then the migration of an intangible that is from India to the overseas location itself could create a tax cost, because you are transferring an asset that is there in India to an outside India jurisdiction. And post that, if India is going to utilize that intangible, then that intangible really requires a income to be generated, in the sense that if India is using that intangible, then there will be an outflow of payment from India to that overseas jurisdiction. So these are some of the considerations when it comes to the pre-incorporation stage of a company, or when it's an outbound stage. I would request Chandru to take over the incorporation stage, which largely deals with the form of entity that we are trying to set up and what decisions go into a company's parameters evaluation as to what should I choose, whether it should be a branch, subsidiary, company, and how does the tax system work over there. So Chandru, over to you.
Good evening everyone. So we look at incorporation. So when they are incorporating a company outside India, first let us look at what are the exchange control regulations. So FEMA guidelines are provided on this. So there are certain prohibited sectors like real estate or banking where you cannot invest until you get a prior approval of the RBI. Other sectors you can invest, unlike FDI where there is a sector specific regulation for multiple sectors. Here only there are some specified few number of prohibited sectors, except which all other sectors investment can be made outside India. Then what are the funds that can be used for investment outside India? One is from residence foreign currency account, or also out of when you have already invested in a company outside India, you can issue bonus shares out of the existing reserves, or if you are not a permanent resident of India, then any foreign asset that you have, that also you can utilize for investment outside India. So what are the entities that can invest outside India? One is company, the other one is registered partnership firms, and also LLPs. So unregistered partnership firms do not have an option to invest outside India.
Individuals also.
Individuals can do an investment outside India under LRS scheme.
Yeah, under LRS scheme, yes. So as a business entity, these are the organizations which can do. And looking at the regulations, net worth should be up to 400% of the net worth of the Indian entity can be invested outside India under the automatic route. If it exceeds that limit, then we have to obtain approval from RBI. Even apart from this net worth criteria, there is also criteria regarding amount of investment. If you are investing more than 1 billion USD, then again you will require RBI approval. Then there are also certain additional guidelines like valuation, how it has to be done, what is the amount. Those criteria are also provided under the ODA regulations. And then there are certain regulations when you are specifically investing in financial sector. Apart from banking, non-banking financial services sector, there are certain specified regulations. And also there are certain reporting requirements, like when you are investing outside India, you will have to file a form ODI. Then annual performance report has to be submitted at the end of each year by 30th of June. And also there is a statement of foreign assets and liabilities, and various other reporting requirements would be there. Then there is a specific guideline regarding how the mutual funds can invest outside India, which are registered with SEBI. Out of proceeds of ADR, GDR, those kind of investments can be made by the mutual funds. Then method of financing, it could be from, as I discussed earlier, travel of foreign currency from foreign currency account, or if you have made some exports, that export process itself you can convert into capital subject to approvals, and also out of EFC account. So when you are investing out of EFC account or from the proceeds of ADR or GDR, Global Depository Receipts, then this 400% net worth criteria does not apply, because you have already earned this foreign currency out of exports. Therefore, this restriction on net worth doesn't apply. Moving on, if you look at form of entity which can be used, whether it is a company, subsidiary, we can analyze under the three broad parameters. So it will depend on the purpose for which you are going outside India, you are making an investment outside India. Suppose if it is for a limited activity, like say sourcing activity, so you are an Indian manufacturer, you want to procure goods, or you want to look at marketing options outside India, you are exploring the market. In such a situation, even without a legal entity, you can take help of a sourcing agency or outside consultant to understand the market, and then looking at the market conditions there, then you can look at setting up an entity or not. The other option could be at the exploratory stage, you can send some of your employees to stay there for some time and then explore the market and then decide whether you really want to invest. So in that scenario, when you are sending employees, you should keep in mind there could be permanent establishment implications. So the period also would be prescribed under relevant treaties. If it exceeds a particular threshold, say 90 days or 180 days, then you could have a P implication.
But exploring the market, P implications would come in place? I'm just exploring the market, I'm not doing any other income generating activities.
Agreed. Suppose the stay exceeds for a substantial period of time, say 180 days. Because of that presence itself, you have a business presence there. So because of that, you may have a P, but there may not be any income attributed to such P. But since you have a business presence, you might have some compliances in that jurisdiction. But I agree that if you are not generating any income, you may not have any tax liability, but there could be certain compliances.
Can it be argued in a way that I am trying to establish my business presence, the business presence itself is not established?
So for the purpose of your business only, you have gone out there. You are looking out for, say, procurement or for sale of your product. That activity per se could constitute business presence. Again, business presence is a very broad concept and it is a grey area. There is no specific definition for that. So it's something activity connected, it has an access to your business, so that could be viewed as a business presence. But there is also an argument possible that I have not actually started any business outside India, so it should not trigger any business presence. The other option is, along with sending employees, you might also hire a consulting agency who will give you the services for that, so that you will only pay the service in expense for that, and you will not have to pursue business presence in that jurisdiction. Moving on, where you have limited operations. Say suppose you have identified a vendor, you want to procure from him, and you want to oversee the activity of procurement. So then you might want to have a business presence there. So starting stage for that could be a liaison office or a representation office. Where you only act as a communication channel. You don't per se undertake any activity like signing contracts or securing the orders. An advanced form of that is, if you want to increase upon your operations, then you could have a branch structure in that jurisdiction. And also, if your operations increase, then you may go for a company. So same way, so this limited operations could also comprise of, suppose some of the activities like accounting, payroll, that if you want to outsource. So this is normally not seen in an outbound scenario. In an inbound structure, many of the foreign MNCs, they house their administrative or payroll activity or accounting services in a jurisdiction like India, Philippines, these low-cost jurisdictions, and do their activities. Where you have full-fledged operation, there you may look at a company or a branch or a limited liability partnership as well, wherever that form of entity is allowed. So in this slide we have alleged various forms of business entity as we discussed earlier. Liaison office, how a branch works. So in case of a liaison office per se, they limit to the activities that are prescribed, like only acting as a communication channel. Then you will not have any PE attribution or any income is not attributed to India. Whereas in case of a branch, it will be treated as a extension of your business, so you will have a permanent establishment exposure in the other country. So whatever profits earned by the branch will fall back to India, and the Indian entity will have to pay taxes on that. Whereas in case of a company, the taxes will be paid by the company, it will be treated as a separate entity. You could also have a structure of JV. In certain jurisdictions, there is a mandatory requirement that for other parties should be minimum percentage should be invested by a local resident of that country. And also in some cases, because of business reasons, you might have a JV partner. That is also another form of investment or outbound investment outside India. Now let us look at a simulation to understand what would be the tax implication under each of these structures.
Before tax implications, please try to tell me.
Yeah.
This Indian company, that major shareholder here in India,
Yeah.
is a major shareholder in the US company also.
Okay.
And that company will be treated as a JV of or subsidiary of this Indian company here in India.
To understand the fact, Indian company.
Indian director is having 80% share in the Indian company.
Okay.
And he is having about 90% shareholding in a small company in US.
Okay.
So that company of US will be treated as a subsidiary of Indian company here under our Companies Act or any provisions or any clarification.
Under the Indian provisions, based on the shareholding, it will not be treated as a subsidiary because Indian company per se doesn't control more than 50% shareholding or voting rights.
No, he is controlling more than voting rights more than 50% as per that 90% shareholding he is having.
But in his individual capacity.
Individual, he is a director here and there also is director.
Sure. But that will be more in an individual capacity than in the company's.
The company itself is not having, but as a director and shareholder, he is having control on both the companies.
True. So they will be independent entities.
So they are not treated as foreign company is not treated as Indian subsidiary. Thank you.
Moving on, regarding tax implications under each of the business entities set up, the representative office, RO or liaison office, branch and company. So first we look at representative office. So here representative office, whatever expenses incurred by it will be reimbursed by the Indian entity. So therefore RO will not have any income per se. Whatever profits earned by the Indian entity, on that it will be paying a tax. So here we have made an assumption that in India the tax rate will be 25%, whereas in the overseas jurisdiction tax rate is 35%. So since overseas jurisdiction does not have any taxable income, so on the profits earned by India there is a tax of 25%, so your effective tax rate works out to 25%. So there is no question of foreign tax credit because you are not paying any taxes outside India and paying credit of it. And also there is no dividend distribution tax because there is no profit parked outside India. So moving on to next structure, branch office. In case of branch office, it's a separate, it's a part of the Indian operation. So India will pay tax on the profits of the branch. But since it has a business presence in that jurisdiction, branch will also pay taxes on its profits. So in this scenario, the branch has a profit of 40, whereas Indian company, suppose it has a profit of 160. Including the branch profit, so on total 200 profit, Indian entity is paying a tax of 50. And also branch, it has a tax rate of 35%. So branch will pay tax in that jurisdiction of 14. So total tax liability is 64. Whereas I will get a foreign tax credit. So here one point to be noted is foreign tax credit is limited to the taxes attributable to such income in India. While the income is taxed at 35% in foreign jurisdiction, in India that same income is taxed only at 25%. Therefore, though I pay a tax of 14 outside India, the foreign tax credit would be restricted to 10. So after reducing the foreign tax credit, my net tax liability is 54. So on an income of 200, if you take 54 of tax, the effective tax rate works out to 27%. So if I move back to previous slide, there the effective tax rate was 25. Because you are operating through a branch, your tax rate has increased by another 2%.
The remaining four ways, can it be claimed as business related expenses?
Yeah, so on that it's not a settled position. Under section 40, there is a specific clause which says that any tax which is paid on income is taxable, is not deductible expenditure. So courts have expressed divergent views. One view is that a tax which is not covered under section 90 because you are not eligible for credit, that is allowed as a business expenditure. But the other view is when you pay tax on your profits, that partakes the character of income tax, whether it is paid in India or outside India. Therefore, that will not be a deductible expenditure. So it's still, I think there is a Bombay High Court decision which says that it is not deductible. But there are other jurisdictions also which have held that it is a deductible expenditure. It's still a litigated issue. Moving on, subsidiary company. In case of a company, it's treated as a separate legal entity. So in this scenario, on the profits of the subsidiary, Indian entity will not pay any taxes. So here again, profit of the Indian entity is 160. On that, 25% works out to 40. Again, subsidiary will pay tax. After subsidiary pays the tax, whatever profit remains, that has to be repatriated back to India. On that, there will be again another tax of dividend distribution tax. So here we have assumed distribution tax of 20%, which works out to 5. So total tax, including the tax on distributed profits, works out to 59. So because there is a tax on distributed profits and also the absence of foreign tax credit, the effective tax rate here would be around 29.6%. So if you look at it comparatively, so when you compare to liaison office, the tax rate is, effective tax rate is least. Branch it is slightly higher, and in a company format it is much higher because of lack of foreign tax credit and also additional tax involved in repatriation of profits. Moving on, we look at various.
The impact will change when the assumed tax rate is different. Tax rate for India is 30 and foreign exchange is foreign rate is lower.
Then it would be the other way around.
Even then, I think branch you will get a full foreign tax credit, but there will not be any tax on the repatriation of profits. Whereas when you come to a company, there is again a tax on the repatriation of profits in most of the jurisdictions. Therefore, effective tax rate when you compare branch and company would most probably be higher.
Yet again here, so the decision point is not really driven by tax always, that you compare what is like to like, setting up a subsidiary or a branch, but it would rather depend on what the business needs. And if your customer is going to be outside of India and there is going to be a signing of customer contract in that overseas jurisdiction, many of them may want a subsidiary over a branch, and therefore the consideration need not be driven by tax. It could be for other reasons as well.
Moving on, various operational aspects. Once you incorporate a company, what are the operational aspects that will arise? My colleague Priya will take up this topic.
Thanks, Chandru. So far we have gone through two segments. One in relation to the pre-incorporation bit. That is, I am in the stage that I know I need to set up a company, what do I do? And then Chandru has taken us through, I want to set up the company and I know which jurisdiction I have to go through, and I have decided what I want to do in that country, and therefore I choose say a company or a branch or an LO depending on what the business needs. Now the next stage is your company is up and running and the operations have started. So in this phase of being an operational entity, what are the tax considerations that come in? Obviously the one is the corporate tax rate of that country itself, but that is not just it. There are other transactions that you will have with the holding company. There could be other employee related aspects that will come in. So we'll study in this section as to what are the potential implications we will have in when we operationalize the company. So when we operationalize the company, we obviously will have intercompany transactions between the holding company and subsidiary in the overseas jurisdiction. And when we have any transaction, the regulations that drive from India are the corporate law, the exchange control, the income tax, and obviously the GST related regulation. And we will have to similarly look for the overseas country, what are the laws and regulations that apply for each transaction. If I have to split the transactions itself into many buckets as to what are the potential intercompany transactions, broadly we can put it under the first bucket of capital transaction, and then the service transactions, your common cost pooling agreements, and then the employee related activities. So the capital transactions are what? It is the infusion of capital into the subsidiary to get them up and running. It could be equity, it could be debt. The equity goes in, either again through an intermediate jurisdiction, or you have a direct investment that is made in the ultimate company. In relation to equity, I think Chandru has discussed quite a bit in this segment that under the FEMA guidelines, up to 400% of the net worth is allowed to be invested overseas, and there is no real restriction over there. The second thing is when it comes to debt, you can actually advance a debt only to a company that you have a direct investment in. You can't advance debt to an indirect holding that you have. So this is under the FEMA, and in FEMA, if it's not there under the automatic route, and there are certain conditions that you can comply and go for an approval route application, but otherwise it may not be permissible. The other point is also in relation to corporate guarantee. Now, a large business house in India has a very good reputation in India, and you have enough banks that have a credit, and this entity has a credible operation, and therefore the banks are willing to give loan to this entity. When you set up the entity overseas, it could happen that you don't have adequate funds to fund it yourself, and you may need to go for an external borrowing. And if you have to go for an external borrowing, what happens is that at that time, it could again come back from the Indian entity that it takes a borrowing and onward exit, or the other option that is commonly sought after is called as corporate guarantee. That is, the Indian entity ties up with its bank in India to say that I will give guarantee for my subsidiary taking a loan from your entity in the same jurisdiction. You have a company in country A, you have a bank in country A, who sign up a corporate guarantee agreement. Based on that corporate guarantee agreement, the bank in country A extends a line of credit to the company which is there, or rather to the bank in country B. It could be its own branch, it could be a branch that it has a relationship with which it has already tied up, and that branch over there in turn extends a local loan to the subsidiary. Now, under the transfer pricing regulations, what happens is that this is a transaction that would warrant a markup, or rather it would warrant an arm's length remuneration, because I as a subsidiary have got this corporate guarantee only because of my parents' credibility and reputation from the bank, and there is a corporate guarantee fee also that is payable. So therefore, the subsidiary normally makes a payment to the holding company for corporate guarantee fees. In relation to service transaction, there is a huge amount of transactions that can come under this bucket. It could be as simple as holding company activities, such as as a group I do all the activities for the group in India. It could be simple things like accounting services, or I maintain the entire IT infrastructure for the group here. I could actually buy licenses for the group in India. Or I could actually develop my research and I could have an R&D center here and give the technological inputs to the relevant subsidiaries as and when they need it, either for manufacturing or for distribution or for any other purpose. Now, all of this, being a holding company, I am incurring the cost. But the benefit is not just derived by me, it's also derived by each of the subsidiaries in those jurisdictions. And therefore, again, from a transfer pricing perspective, the advancement of these holding company services or the common cost that the holding entity bears will have to be cross-charged to the overseas entity. And these are typically referred to as intra-group services. Another aspect is also commission. We also, Chandru took us through the entity forms of setup, and one of the entity forms that we looked at is in the mid stage, which is not really doing a full-fledged operation, say, of manufacturing or trading, neither is it in an exploratory stage. And a typical model for that would be marketing services. That I have an establishment in the overseas jurisdiction which markets my products and services, and it does not really do the product, it doesn't manufacture, it doesn't sell in that jurisdiction on its own. Now, for manufacturing service, for marketing services in that overseas jurisdiction, again I have to pay a commission to that entity. Now the minute the commission comes in, you have TP regulations, you have withholding tax regulations also coming in. As in whether the commission that I pay from here to the overseas company requires a tax to be withheld. Similarly, moving on, you could also have the transfer of intangibles that we discussed earlier, that I can do a one-time transfer of intangible, or I could actually give technology support to the overseas jurisdiction. And if I earn a royalty income from that, there are some benefits available under the Indian Income Tax Act at a reduced rate of tax. The next one is in relation to common cost pooling. Now when it comes to common cost pooling, there is one point that I would like to highlight here, that from an Indian jurisdictional perspective, common cost pooling and cross-charge is not really a recognized concept. In many of the overseas jurisdictions, if you have common costs incurred for the group, and typical examples would be like travel or a license that you procured globally in one jurisdiction for negotiation purposes, and then you distribute it, there are countries that say that these are third-party costs, and I am ready to pass it on as is basis without really adding a further markup to it. But from an Indian context, largely it has been held that these common costs should not really be a common cost that is cross-charged, but you have invested your time and effort and working capital in it, and therefore it should be again marked up with a remuneration. So it may not be, so common costs as such may not be a recognized concept, but when we deal with MNCs, we hear that, these are third-party costs. Why can't I just cross-charge it? Why do you really need to, mark it up further? So this is another aspect that I thought I should leave, you with. In relation to employee-related activities, typically two things come. The first one is in relation to the secondment of employees. Having set up your own subsidiary there, you, for your own comfort reasons, may want people from your office to travel and sit there, either in a supervisory role or in a technical role, to oversee the operations of the overseas jurisdiction. And at that time, you have a secondment of employee, and there will be issues associated with that. This is a separate topic that we are going to deal with in the next few slides. Apart from that, you could also have ESOP related items. That is, when I set up a company over there, and I am a company that's floating ESOP to my Indian employees, I might also want to float ESOP options to the overseas entities. So this is another aspect that we have covered in the subsequent slides. This slide summarizes the tax rate in various jurisdictions. We have picked a sample of about 8 to 10 countries which give the corporate tax rate. So obviously in India we know the tax rate varies from say 25 to 30 to 40%, and then we have Australia, which is at about 30%. Japan has a slightly different tax structure, and it varies depending on the city where it is, but largely it's about approximately 30%. Singapore tax rate is about only 17% and is one of the lowest in terms of where operations are carried out. China is, I think, more or less aligned with where we are at 25%. Germany is around 30 to 33, France is 34, Italy it varies, but the statutory rate is 24. UK has reduced it from 20 to 19, and I believe there's a proposal to reduce it further. And USA, with the latest reforms that it had towards the end of last year, has done a drastic reduction to 21%. So this is the effective tax rate in terms of corporate structure. Largely, except for India, which treats branches tax rate at a different rate, it's otherwise in most countries it's aligned to the same tax rate as it would be in the case of a corporate. We have also outlined the withholding tax rate. So the first two columns what we deal with are the income tax rates that would apply to income earned in the foreign jurisdiction by that subsidiary. But the last three columns are in relation to the withholding tax that the subsidiary has to remit or deduct when it pays any money out from that country to, say, India or any other country. Now these are the domestic tax rates that we have outlined, and there could be variation in terms of if there is a DTA between that country and the subsidiary's country, the tax rates could further go down. So in India we do know that dividend there is no withholding tax, but we have a DDT payable at approximately 20%. and you have a royalty and FPS rate of 10% under the domestic law, which is further increased by surcharge and cess. And the interest really varies from 5 to 40%. Apart from that, if you look at most of the countries, the withholding rate really ranges in the range of 10 to 15%. So this is just a reference to understand, the rates that different countries apply. Now, the next concept that I would like to move over to is the place of effective management rules. This is a very interesting concept, and this has come about in the Income Tax Act in India 2 years back. In 2016, there was an amendment to the definition of what constitutes a resident in the Act, and thereby expanding the scope of residence in India. So if you look at it, historically, a company is a resident in India if it is incorporated in India or the whole of the management and control is situated in India. But now this amendment says that a company is incorporated in India, yes, it is a resident, but also the second limb says that its place of effective management in that year is in India. And you have an explanation to what poem is, which reads, a place where key management and commercial decisions that are necessary to conduct the business of an entity is, as a whole, is in substance made. Now, what it really means is that you have a company. Sorry.
So, answer the definition that would be a poem in India.
So, if you look at the overseas entity, it can become a poem of India. So, it can become a tax resident of India because the director is here, but only if all the conditions that he will visit through are satisfied, which is essentially, is he the only person making the decisions, which is managerial and commercial, and whether there is a board over there, and whether in substance the board simply signs off on paper and all of that. But it could qualify as a prima facie case for evaluation of the poem guidelines. Yeah, so coming back to this definition of poem, now, two things that I would like to highlight over here. The first one is that, so if we have companies which are outbound investments, this is one of the aspects that we should definitely highlight to our clients to say that, hey look, if you have an overseas jurisdiction that you're running the operations from India or taking key decisions from India, then that company could be treated as a tax resident of India. We'll come to the implications and what happened, all of that later, but this is the prima facie. The second thing I would like to highlight here is this is not really restricted to outbound investments. It could also come in the case of inbound investments, wherein you have a US entity that is invested in India and the Indian entity manages the APAC region. So the Indian entity managing and taking decisions for the APAC region could also mean that the APAC countries that it manages could get pulled into India for tax residential status. So you have a group of people sitting in India who are not only responsible for the India operations, but they are, say, the MD of APAC region. You have a CFO for the APAC region, and they sign off on the APAC region as such. So all those independent countries, the companies which come under the APAC region could get pulled into India for poem purposes. So this is another thing that we should always bear in mind, that it's not just for outbound, it could also apply equally for inbound investments. So now what really happens when this is a poem? So even before we get into the implications of a poem company, there is two items that we should look at. One is key management and the other is a commercial decision. So poem triggers when the key management and the commercial decision in relation to that entity are in India, which means that the central important management function of that company, for example in that definition that you wanted to discuss, in the example that you wanted to discuss, if the director in India is going to take all the decisions for the US entity and the board over there simply signs off on paper saying that I agree, and there is no real discussion over there in substance that happens, yes, then that can get pulled into India. Similarly, the strategic decisions of what that company should do in terms of the product lines or the service lines, and what should it do with the customers in terms of pricing and negotiation. If all these decisions, that is the act of management, is actually taken place in India, then that company can be regarded as a tax resident of India. The other aspect that has to be noted is that it would also include decisions such as financing the business transaction, investment policy of that company, business strategy, production and marketing discussions, expansion of business, appointing executives and execution of material contracts. So largely anything in relation to business can get covered.
If these decisions are taken by an Indian resident by visiting that office and then the decisions are taken there, then it will be also a poem?
So that's a very interesting question, and that's one of the ambiguity areas that we have pointed out to say that if he has actually travelled to those jurisdictions and taken it at the time when he was locationally there and along with a board and a management that is sitting out of that jurisdiction, there should not be a significant issue. It is largely in relation to when, in the land we hear that we take the decision, and that decision that is taken here is completely abided by over there, and there is no other thought over it. So whatever is taken as a decision here is complied and executed there.
If this goes as a recommendation and then they take a decision?
So again, it's just a paper sign off. So then it would not qualify.
Just a recommendation, not mandatory for that to.
Yeah, so it's a recommendation. They think through, they evaluate, put parameters of pros, cons, and then take a conscious call, then it's different. Which means there could be decisions that India proposes, they dispose, and there could be some things that they accept. In that case, you have a better chance to say that there is no poem.
Or if they give, say, 4 alternate ways of doing it, and they did take one of them, then the decision will be there.
Yeah, absolutely.
As far as board decisions are concerned, it is a board decision, not the individual decision. Maybe a recommendation may go from India, but it could be a board decision there in that US entity.
But as Madam says, if it's only a routine thing.
How it is treated, it is a board decision.
So if it's a board decision, again, on a routine basis, so you're not going to just evaluate one fact pattern here, you're going to evaluate throughout the year what happened. And even if it's part of the year that a place of effective management has happened, it could trigger. Which means to say that if I have had 10 decisions that India took, and all the 10 of them have been accepted and signed off by the board, then it's, you're just saying that it was India's decision that the board has just signed off. But on the other hand, 10 of the strategic items that came from India, the board took a conscious call and implemented only a few of them and not all of them, then there's a chance to say that yeah, they had an independent thought and they applied and decided what's good for that company. Now, this covers both management decisions and commercial decisions, which means that management in the capacity of a shareholder or management in the capacity of acting on behalf of the company and supervising the company's operations as such, or it could be commercial decisions in terms of vendor contracts, customer contracts, employee-related matters, and the whole ambit can come. So the examples that we have for management decisions are appointment and termination of key managerial personnel and their remuneration, reporting structure and key management policy, code of ethics of the group IT systems policy, MIS reporting, M&A and restructuring, common procurement, capital expenditure. Now, one point that I would like to highlight here is it's not independent of each other, neither is it cumulative, but it is very fact specific that we'll have to look at all of them, and these are some of the factors that we should look at. It doesn't mean that everything that the overseas entity does on its own, but we have a common IT infrastructure. That doesn't mean that the poem automatically triggers. That might be more for the business consideration that I had to have a common IT infrastructure. But that alone cannot be a decision maker for poem. So it's a cumulative factor. There is no list of, this is the checklist, I tick off yes or no and I come to a conclusion, but it is a subjective issue.
Because from the business angle, if that person wants to control the business from here only, it's better that he only gives the instructions rather than allowing somebody else to take a decision outside India.
Agreed.
So he may take, if he is given the permission to take decisions, he may take decisions which this person may not appreciate.
Yeah, but it's not commercial considerations, I would say. In terms of commercial decisions, it could be items such as deciding vendors, distributors, negotiation of contracts, whether it's vendor contract, customer contract, employee contract, or third party other contracts, lease and whatever. Product portfolio that has to be sold in the overseas jurisdiction, how it should be sold, how it should be marketed, and then the R&D and the brand, how it's used, the fundraising decisions of the overseas entity, there's a requirement for fundraising the overseas entity, who decides that? Is it coming back to the holding company or is it going to be the decision of the overseas entity? And then the pricing of products and all of this. But yet again, none of this individually will contribute into a poem situation. We'll have to look at it in a holistic scenario basis, and there is no point system or a checklist system that we tick off and then figure out whether it's a poem or not. Now, this is a flow chart that can be used at a high level basis in principle to figure out if there is a poem. The poem threshold is being prescribed at 50 crores. That means if the overseas entity's turnover crosses 50 crores, and it's only then poem can get triggered. In identifying poem, typically the steps that we can go through are: step 1, identify persons who actually make key management and commercial decision for conduct of company's business as a whole. And then you say that if that's the Indian entity, you move forward in the blue chart. If it's not the Indian entity, you move forward in the green, towards the green box. And the green box says, because that ends faster, I'll finish that only if you have an active business outside of India, you need to look at it. In the international tax parlance, you have something called as active income and passive income. Active income is what the company earns on its own through rendering services and marketing and selling products and distribution and all of that. Passive income really relates to income which is arising out of a resource, and it's largely in relation to the intercompany transactions such as your royalty, fees for technical services, the interest and all of that, which is where the asset in relation to the income itself is passive in nature. So if there is no active business income, then again the poem trigger can appear. But if there is an active business income, that's when we have to evaluate the. When there is an active business income, then the poem trigger is lesser because they are running their operations. They have their own set of employees doing the activity.
To bring under this poem ambit, is it income tax department is asking any questionnaire or anything like that?
So that's a very interesting question because it is a new concept, and if I have to step back a bit, in 2016 when this was initially announced, the companies itself were not prepared as to what is the evaluation parameter that we need to look at. And poem in an international tax concept has been used as a tiebreaker clause. So again, just to explain what a tiebreaker clause is, under the tax treaties, you have an article which deals with how do you determine residential status of a company if it qualifies as a resident of one country and the other. And poem was at that time used as a tiebreaker clause to figure out, okay, so you have an activity in country A, you have an activity in country B, and both the countries are saying you are my tax resident. So how do you decide which country's tax resident are you? So poem was used to tie break into which country you would actually form tax resident of. So to coming back to your question, so when it was used as a tiebreaker clause, today we have introduced it as a definition for determining residential status as such, one. And up until December 2016, if I remember right, there was a draft guideline that came, and then that said that these are the considerations, and the company said that yes, poem has been implemented, but these guidelines have come 9 months into the operations of the country, and therefore the industry is not prepared to take this. And that's when that was withdrawn and all of that happened, and finally the guidelines. While there are some guidelines as to how to determine and all of that, the impact and the circular which deals with the impact of poem has come in only in 2018. So you do have some guidelines, but then it is not a concrete set of guidelines. It's only a guideline to determine these are the parameters.
Guidelines moreover does not have legal backing.
Yeah.
6.6 does not say that make reference to the circular as we discussed.
Absolutely.
So it is academic.
Absolutely.
Going against SSC, you can as well challenge this thing.
Absolutely. So the second step is to determine whether decisions are taken in the overseas jurisdiction or in India, and then the key management and commercial decisions for conduct of company's business, where are they made. If all of this is satisfied, yes, it's poem. If it's not satisfied, it's not. Now, place of effective management, we did discuss this in a bit, a bit ago, that it was introduced in the Finance Act, 2016 with effect from 1st April 2017, but the guidelines came and then it went back, and then the CBDT issued a press release in 2017 inviting comments for draft notification, and then the final notification came sometime in June 2017. One point that I would like to highlight here is, what do you think would be the tax rate if that overseas country's company gets pulled into India? Yeah, so that's the answer. It's not 30. Although we are a tax resident of India, it doesn't qualify as a domestic company. So it's still a foreign company. So when you go to the tax rate section, it goes back to 40. So the notification highlights what is the computation of total income, how to compute it, and if you are going to be drawn into India, then how do you treat unabsorbed depreciation? How do you treat financial year ends? They could have a different financial year end, I could have a different financial year end. Set off and carry forward of losses, collection and recovery of taxes. You pay tax in that jurisdiction, you're saying that you have to pay tax here also. So how do the FTC credits work? And then there are also special provisions in relation to avoidance of tax in both. So one point, poem as a concept itself is very elaborate, but I'm just trying to touch upon this because it's relevant for outbound companies. Now ambiguity, there are quite a few areas of ambiguity in the poem related aspects, and I think sir, you had a point to make that if the director makes a decision, so the location of decision doesn't matter. Extending that one step ahead, if he does it through a video call, I mean, where do you say that the location lies? Is it that all the other board of directors are sitting there and there's only one person who's sitting here? Is it okay? But this person decided what the final outcome is. So that's again very subjective. It's ambiguous. There is no clarity on that right now. Sorry. Now, the minute you say that the overseas company is actually a tax resident of India, do you really apply transfer pricing rule provisions or not for intercompany transactions? That's another issue that is unresolved. The next one is with regard to withholding tax. So which means if that company is making remittances all over, should it deduct tax under 194C, J, 195? Okay, but that's not really a clear-cut position, so to say. There's no clarity. So that's a position that needs to be taken on a case-to-case basis as to what do I do. Because you don't qualify, you are a foreign company, but you are a resident. You're not a non-resident to be qualified under 195. So that's the issue over there. The next...
Transfer pricing is now applicable for within India also.
So SDT really applies only in scenarios where you're claiming tax holiday and then the SDT limit itself is 20 crores. So it doesn't apply to all cases. Then the applicability of MAT. The overseas company would normally prepare your financials in their GAAP. They are not going to prepare an Indian GAAP unless there is a reason for consolidation. How do you go about preparing MAT computations? This is another ambiguous area. The next one is, place where functions are performed versus place where decisions are taken. So I go there, I sit, we discuss, and you deliberate on all the options. You come back to India and take the decision. So then, do you say in substance it's taken there and is signing off here? Or do I necessarily have to go to that jurisdiction, sign off and come back? So there are a lot of grey areas when it comes to poem. And this is a very hot topic when it comes to outbound companies and regional headquarters companies. The next aspect that I would like to touch upon is in relation to anti-avoidance rules. The GAR related provisions which are effective from 1st of April 2017, that is the financial year beginning 1st of April 2017. The anti-avoidance rules initially came into the Act about 6 years ago and it kept getting deferred. So initially it was proposed in the DTC and then it got introduced in the Income Tax Act and it kept getting deferred because there was a lot of apprehension from industry on how this would be applied. So there was a lot of time that was given to industry and the GAR has now come into force, and the first year where it applies is 17-18 financial year, which is S20 18-19. What is GAR? Now GAR refers to a set of transaction or even a part of a transaction that a taxpayer enters into when one part of the transaction can be disregarded and treated as an impermissible avoidance agreement. That means out of a transaction, even one part of it can be disregarded and treated as an impermissible avoidance settlement where that transaction leads to a tax benefit. The main purpose of entering into that transaction leads to a tax benefit for the taxpayer, and the threshold has been prescribed at 3 crores. Which means if there is a tax benefit that the taxpayer is availing, which is in excess of 3 crores, then it can be reviewed by the tax authorities under the GAR provisions.
3 crore. Is it in one financial year or spread across?
So there is, it is actually could be accumulated also. It is not per year, and it does not restrict. So if you look at it, there is no grandfathering, so to say. That if you have entered into the transaction say 5 years ago when GAR was not there, but the tax benefit of it is coming out now, even then it can get covered under GAR. The GAR definition has 4 tests that we have to go through. I will say that you start off with the base, which is you should have an arrangement, and the arrangement should lead to a tax benefit, 3 crores being the threshold. And then you look at each of the limbs out of the 4 limbs, and even if one limb is satisfied, it is sufficient to say that GAR can be invoked. So for example, the first one is creates rights or obligations which are not ordinarily created between persons dealing at arm's length. With this coming in, even for third-party transactions, can you actually do it on anything other than fair market value? Earlier we used to say for third-party transactions, if there is no TP requirement, you can do it at any price. But with GAR coming in, it looks rather difficult to apply, any transaction without an FME exceeding the threshold that it has, so there is a mandate in the GAR that most transactions should have been as FME. The next one is in relation to results directly or indirectly in the misuse or abuse of the provisions of the Act. So, if the transaction has been structured in a manner that the main purpose of it is only to avail a tax benefit, then yet again it can come under GAR. But if you have business reasons to demonstrate why a transaction was executed, which are far outweighing beyond the income tax reasons, there is an argument possible which is subjective. The next one is lacks commercial substance or deemed to lack commercial substance in whole or in part. Simple example, you have a company that is floated, it's shell in nature, it does not have operations when you make an investment, and there are no employees to take decision, everything is taken from here. Again, that entity could be treated as a shell entity or a conduit entity and disregarded from a GAR perspective. And the last one is entered into or means carried out in a manner which are not ordinarily employed for bona fide purpose. That's the transaction is not genuine. If all of these are satisfied, then we say that the GAR text is satisfied. And the tax officer can invoke GAR. There is a process to invoke GAR, which I'm again not going in depth over here. The other aspect, in outbound investment is in relation to BEPS. Base erosion and profit shifting, is an action that has been initiated by the OECD along with the G20 countries, and I'm sure we've all heard enough about BEPS so far. So, the tax authorities around the world believe that companies are structuring their tax arrangements in such a manner to avail tax benefit. So I set up a manufacturing company in a country where I have incentive, I export it and sell it out of a country where the corporate tax rate is low, so the profits are parked there. And similarly, every leg of the transaction is structured in a way that, and you source it from a country where there is no fee for sourcing. So you can split the whole supply chain in such a way that you get tax benefit. That's one of the examples. So that's when the action points on, BEPS was drafted, when tax authorities around the world came together and figured out that, look, we might be collectively losing out on tax and those numbers are predicted to be huge. So the BEPS action point also has one action report, which is called as action number 6, which particularly, talks about anti-abuse and treaty abuse. So, I'm not getting into depth here, but this is another point that could come in the near future and that we should be mindful of, because this could also impact the GAR related, it could impact the outbound investment related provisions. Now I would request Chandru to come in and take over some of the other items that are in relation to the outbound investments.
So some of the other items in relation to outbound investment, one is employee engagement regarding outbound secondment. As we discussed earlier, so once you expand operations outside India, sometimes you may need your employees to go to the overseas countries to oversee the operations. So when your employees go out there, so it will be normally under a secondment arrangement, wherein they will continue to be your employees under the payroll, but for a limited period of time, they will be working under the supervision of the foreign country or under the guidance of the foreign country. So such an arrangement is commonly referred to as secondment. In such a scenario, in order to secure their social security benefits, normally Indian entity would pay their salary and then get it reimbursed from the foreign entity. In such a scenario, when you get the money back from foreign country, one question would be what is the nature of such transaction. Indian authorities could treat it as a fees for technical service and tax it. And the other aspect covered over there is when employees work there for a substantial period of time, if they are doing Indian entities activities over there, Indian entity could have a PE, permanent establishment exposure. So permanent establishment exposure could come in three ways. One is the fixed place PE, and then service PE, and also agency PE. So we'll just discuss in detail about these three aspects. Fixed place PE is something where you carry on your business, a fixed place of business, place through which your business is carried on. So three main criteria for a fixed place PE to trigger, or you should have a fixed place through which the work is carried on, and that place is at your disposal, and it is a permanent place. So when an employee is working, if he is given a specified location and a cabin and he is working through that, that fixed place condition would be satisfied. And if he is working for a substantial period, then permanence test also would be satisfied. The final test in that is whether Indian entity's business is being carried over there. So if he is doing only for the foreign entity, their business operations, then this test may not be satisfied. But that will have to be looked into based on facts of each case. Suppose India has subcontracted certain activities to the foreign entity and he is overseeing such operations, it is more of a supervisory in nature and it is to protect Indian interests, then it could be treated as a portion of Indian business is being carried over there. Then looking at agency PE, so where contracts are signed on behalf of the Indian entity over there and he habitually signs or secures contract, then that will be covered under agency PE. And also in certain tax treaties, there is a specific provision regarding service PE. That is where you render services to your employees or other personnel and that services continue for a specified period. It depends on treaty to treaty. It could be from 90 to 180 days, and in some cases if it is an associated enterprise, even for one day your employee go and render service, you could have a PE exposure. So if you have a PE exposure, then you will have to attribute what is the amount of income that is attributable to activities of such employees. Then to that extent you will have a tax liability in the overseas jurisdiction. Moving on, another aspect relating to outbound investment is employee stock option plan. So this is a common practice followed by many of the corporates. In order to retain talent and also to compensate employees, they would give stock option plans to employees. So when you go outbound and you invest outside India, the overseas jurisdiction employees also Indian company might want to compensate. Then Indian entity shares or stock options may be issued to those employees. One of the factors to be considered is how do you manage this ESOP plan? Either it could be directly by the company or they could set up a trust through which they could manage this ESOP. The other aspect is taxation in the hands of the employees. So when you issue the stock options, what is the tax treatment in the overseas jurisdiction? Do you have to deduct taxes at source as salary as per laws of that country? And also the ESOP expenses. Indian company, if it is issuing options to employees of its subsidiary, the fair value of that option, should it have to recover it from the overseas jurisdiction? If you don't recover, that could also be questioned under transfer pricing regulations. Moving on, other cash repatriation options, or one could be interest and other option could be dividend, apart from various like royalty or fees for technical services which are already discussed. So in case of dividend, it is taxable in India if it is from a subsidiary where you hold or an entity where you hold more than 26%, then the tax rate would be 15%. And also when you receive dividend from a foreign entity which is a subsidiary, that dividend income can be reduced from the dividend that you are declaring in order to calculate your dividend distribution tax. So basically when you are declaring dividend, you have to pay dividend distribution tax at rate of 22%. So when you are calculating that liability, you can reduce the dividend that you have received from your subsidiary. One of the issues that could arise here is, during a year, if you, there could be a timing difference. So in the initial beginning of the year, after the AGM, you may declare dividend, but you will get the dividend from the subsidiary maybe at the end of the financial year. So as per provision, there is no guidance on carry forward or carry back. So in the current year, if I am not able to utilize that credit, I will not be able to carry it forward to future years. And then interest income, it is also taxable in India, and there are the rate of taxation, it varies from 5 to 40%. In specified conditions are satisfied from for infrastructure bonds and other things, the tax rate is at a lower rate. And also when you are earning interest income, that means you give loan and get the interest income, you should also look at thin capitalization rules in respective jurisdictions. So thin capitalization rules, to put it briefly, where you are leveraging the equity and debt, if you have your debt component is higher, then tax authorities could give a limit on the amount of interest that to be paid when compared to your profits. In India also recently this provision has been introduced under section 94B, where 30% of your EBITDA can be paid as interest. Any interest over and above that to a related party would be disallowed. Moving on to other issue is foreign tax credit. Foreign tax credit could be of two types. One is unilateral tax credit and bilateral. So unilateral is something where even if India doesn't have a double taxation avoidance agreement with another country, if the taxpayer is able to show that he has paid taxes outside India, he will get a credit of that. The bilateral tax credit is under section 90 or 98, where you have paid taxes outside India and you have a treaty benefit, then you will get a tax credit in India, and the same treatment vice versa will also apply. That means a resident of that country, if he earns any income in India, he can claim a credit of that outside India. And there are two methods of giving foreign tax credit. One is exemption, where you don't tax that income at all in the resident state. This is normally not found in India's tax regime, but certain other jurisdictions do follow this. The other method is credit method, where you tax that income both in India as well as the source country. Later you give a credit of such taxes. Certain issues when you are claiming foreign tax credit, or normally in the treaties there is a condition that amount of tax credit that you claim should not exceed the proportionate tax that you are paying on that income in India. As we saw in our earlier example, suppose you are paying taxes outside India at 35% and Indian tax rate is lower, say 25%, or say dividend income you are paying at 15%, then only 15% of the taxes that you paid outside India would be available as credit. Then what happens to the unutilized tax credit? As we mentioned earlier, this unutilized tax credit, it is a grey area. While you can claim it as a deduction, as per provisions of section 48, any taxes paid on your income would not be allowed as a deduction. So whether taxes paid within India only gets covered or any taxes on your income gets covered, it's still not a settled position. Till now we have discussed about the various operational issues. Now we'll look at what are the exit strategies. So once you make investment outside India and you have earned sufficient profits, and if you want to exit out of that venture, what are the options? So Priya will discuss on this.
The FTC, US countries there is one thing called federal tax, there is something called state tax.
Yeah.
Federal tax I take section 90,
Yeah.
state tax 91.
Yeah, I think there are decisions. I think Bombay ITAT decisions are there, which are holding that state tax you can claim. But technically, if you see, for state taxes is also paid in US, and India has a treaty with US.
With respect to that tax, we do not have treaty.
Yeah, I think that is the position that has been taken and that has been upheld by the courts. So you can take that stand.
So we'll move on to the final section of the deck, which in relation, so we started off with the pre-incorporation, incorporation, operationalization and other items, and then we'll wind this whole thing up with exit strategies. Exit strategies, could really fall under a few buckets. One is that you set up subsidiary for a particular project or a particular reason. That project is completed for business purposes and you don't have any other activities, therefore you want to wind up and come back. That's one. The second one is in relation to sale of subsidiary, that is, You set that up as an independent entity, it's up and running on its own, and maybe the business line is not in line with what the parent company is doing. And you want to exit that business for whatever reason. So that's when a sale of business can happen. The third one is an M&A transaction where you could actually merge that entity or demerge its operations into another totally different entity which is a third party group. The last one is also in relation to externalization or dilution or listing. You have a company in a third country. Technically, if you look at it listing, you would always want to do it in the home country jurisdiction because the value up the chain is the highest. But if for some reason in the subsidiary you want to raise funds, or you think that again the business line is different and therefore I would like to hold only so much interest and therefore want to externalize or list it, that is another option that we can go with. So these are the strategic reasons for exit or winding down that entity. The tax implications largely would revolve around two aspects. One is a capital gain aspect and the other is an accumulated profit aspect. The capital gain aspect comes when you actually transfer an asset. In situation 1, when you complete the project and wind up, what the law says is to the extent that there is an accumulated profit in that country and that's being distributed, it will be taxed as dividend in India. And to the extent that there is a capital gain that is over and above the accumulated profits in the country, it will be treated as a gain, capital gain. When it comes to the sale of a subsidiary, you are actually going to transfer asset, which is the share in the overseas entity. And when that happens, it's simply only going to be capital gains. One point that we need to note when we sell shares of an overseas entity, if it is direct, it's capital gain. But like India has indirect transfer provisions, some of the overseas jurisdictions also have the indirect transfer provisions. Which means if you're not selling directly the entity that you are invested in, but an indirect entity, so for example, you have company A invested in B, B investing in C. You are selling off B's shares and not C's shares and assuming all of them are in different jurisdictions. So then you will also have to evaluate whether the value of B is substantially derived from C and therefore country C can come back and say, hey look, you transferred company B shares but then the value is derived from my country and therefore you need to pay tax here. So that's the indirect transfer provision that we need to be mindful of when we look at the transaction for exit. Merger and demergers, so this is slightly more of a area that needs more of deliberation because outbound mergers and inbound mergers are strictly governed by the corporate law and the exchange control regulations, and you need approvals both in our country and also the outside jurisdiction, but that's another option that could be explored. And then you have the exit by externalization, and that could come in either of the earlier forms, which is either you dilute the promoter stake or the Indian entity stake, or you issue fresh capital and list it. So there are various reason combinations in which this can happen. Now in all of this, yet again we'll have to visit GAR, we'll have to look at the limitation of benefits clause under the treaties, the domestic tax implications under each of the countries, and also the legacy related tax issue. So if you're going to sell off a company or if you're going to acquire a company for that matter, does it have legacy litigation issues that you want to be associated with, and therefore you acquire the legal entity as such, or do you just want to incorporate a new entity and acquire only the business without the legacy issues? So these are some of the considerations that we should look at, and from an outbound perspective I can tell that compliance is one thing, reporting and compliance, all of that is one, but there are areas like POEM, like GAR, that we need to be mindful of when we execute transactions, the transfer pricing also for that matter, for all of this. I think with that, we wrap up. We have another 10-15 minutes for questions. Happy to hear questions and answer.
Choice of undertaking or other incorporation between branch and subsidiary, will it be covered under CAR? I think branch will lead to tax in India, so subsidiary tax will be there outside. Profits will be there outside India. So CAR can it be invoked to say that incorporate only branch, or other build up a case why subsidiary has to be incorporated outside?
Yeah, so that is a very interesting point, because if you look at branch versus subsidiary,
even equity versus
debt, absolutely. So, this actually gives rise to a very interesting question as to when does GAR apply? Does it really apply only to restructuring transactions, capital transactions? No, it really applies even to everyday transactions that companies are executing. And it is just not limited to structuring, M&A and capital infusion transactions. That's one point that I would like to make here. Having said that it does apply to these transactions, the choice of an entity, whether I choose even in an overseas institution, I can choose a quasi company like a partnership or an LLC or an LLP, or whether I choose a branch or a sub and all of that, is a decision of the business that happens. Because the choice of what I want to invest in and why I want to invest in not always is driven by tax. And if you have documentation to prove that it is not a tax-driven decision, and also to prove that this company which is this GAR really does not trigger because of this, I think we could have a case. And there is the circular also on GAR which clarifies some of the FAQs, which actually says that if there are more than one options available to the SSE to choose how he wants to structure the transaction, GAR cannot be invoked. Which means if I as an SSE can choose whether it should be a branch or a subsidiary, technically it's my business decision to choose one over the other, and we can take that argument although it comes through an FAQ and a circular. Thanks. Any other questions?
The Supreme Court in the case of estate builders, that the subsidiary business is my business. So considering the transactions in the case of corporate guarantee, service transactions, and the common cost related stuff, can I say that to further my business, in furtherance of my business, I am incurring all those, or maybe I am getting to all those transactions. So there is no need for me to charge the subsidiary.
Well, so if you look at it from a third party perspective, because when you say it's an overseas entity and TP automatically comes in, you will have to look at it from, if it were an independent company, would you have borne that cost? So the answer I would assume is no, because it is a third party entity and you are incurring costs for furthering that, furthering your own business. I am assuming that it would be built into the cost somewhere. So given that in a third party scenario this would not apply, it may not really sell through as an argument. Any other questions? Do we wind up? Sure.